Hello friends, welcome to Simplify with Swati. In this video, I will be talking about the concept of time value of money. The time value of money is a fundamental or core concept of finance, and it is as useful and applicable to businesses as it is to an individual investor. A proper understanding of this concept can help in taking rational financial decisions and lead to better returns on investments. So let's start. Time value of money in simple terms means that a rupee in hand today has a greater value than the same rupee in future if there is a potential opportunity for investing it. This is because a rupee today will buy more items than what it would buy in the future. As the inflation rate increases, the prices also increase over time and the purchasing power of the rupee decreases. The potential earning capacity of money is in the form of interest. So the value of rupee today will be greater than what it will be tomorrow, or even the value of rupee yesterday was greater than what it is today. Understanding the time value of money will be helpful in evaluating and comparing the outcome of two or more investment options. Suppose, for example, you have rupees 1000 at the start of the year and you get an opportunity to invest it and earn an interest at the rate of 5% for 1 year. Then you would have rupees 1050 at the end of the year. So basically, rupees 1000 today is worth rupees 1050 after 1 year. But by waiting for this money, that is rupees 1050 for 1 year, you may forego an opportunity which could improve your overall financial position. This is called as the opportunity cost. The opportunity cost is the value of the next best alternative. So suppose you have to pay your debts or you have an opportunity to invest in a business which may improve your present financial position. Then it's better not to wait to receive that money after 1 year. Rather, utilize it for your present use. So out of the two options of investing the money at 5% and waiting for returns after 1 year or retaining the money for present use, the decision can be made easily by evaluating the time value of money. Now let's understand the factors which must be considered while calculating the time value of money. First of all, the interest rate, which is a charge against the use of money paid by the borrower of money to the lender, in addition to the actual money or principal. A comparative evaluation of the interest rate and the opportunity cost of money can help in choosing the more profitable alternative. Secondly, the rate of inflation in the economy affects the purchasing power of money due to a general increase in the level of overall prices. The next factor is default risk, that the money will not be returned at the end of the investment period. Now I will talk about the techniques that are used to adjust the time value of money. So compounding and discounting are the methods that are used to calculate the present value and the future value of money. This helps in comparing and evaluating two or more alternatives by making their base same, and also helps in taking informed decisions about what to do with the funds or which investment option is better. Here I would like to explain the concept of present value and future value. Future value is the value of money at a future date, and present value is the value of money today or at present, and that which will be received or paid in future. So basically it shows how much future value received at a time period in future is worth today. So compounding is used to calculate the future value of an investment made in the present. Compounding helps to determine the future value, which basically tells you how much will the amount invested today at a particular rate of interest will grow into at a specified time in future. It is widely used by financial planners and investors to predict the amount of return that can be generated by investing in assets or stocks. And discounting is used to calculate the present value of a sum or stream of such sums. It basically helps in calculating the value of payment that will be received at a point in future. So we are discounting back a future amount to bring it to its present or current value. Now let's talk about compounding in some detail. So when you make an investment, you do so with the expectation of getting a return. This return is accrued in the form of an interest, and these returns can again be invested to earn more money. So while compounding or determining the future value of an investment, the simple interest or the compound interest methods are used. In the simple interest method, the future value is calculated for a single amount paid at the start of the period. This amount is left intact for the duration of the investment at a constant interest rate. With simple interest, it is assumed that the interest rate is earned only on the initial investment amount. For example, an investment of Rs 1000 is held for 5 years in a savings bank account at 10% simple interest rate, which is paid annually. In this case, the future value or the amount to be received at the end of the investment period of 5 years is Rs 1500. Now coming on to the compound interest, here the interest rate is earned on each period's cumulative account balance. For example, you have Rs 5000 today and you invest it in a scheme which pays you interest at 5% for 2 years, and interest is compounded annually. So the future value of your investment will be 5512 rupees. Next is discounting, which helps in finding the present value of an amount which has to be received or paid in future. So suppose you need a corpus of 20,000 rupees after 10 years and you want to start investing today so that this amount can be accumulated. So you find a suitable opportunity where you are getting interest at the rate of 5%. So the amount that must be invested today is 12,278 rupees. This is the present value of the future money of rupees 20,000. The calculation of present value is important for businesses as it allows a comparison between the amount to be paid or received at different points in time. For example, suppose you have two options. In option 1, you can take rupees 1000 in cash today, or in option 2, you can take rupees 1100 a year later. So to evaluate these two options, we must know what present value would equal to the future value of rupees 1100, or how much money would you need today in order to have rupees 1100 a year from now. The calculation shows that with an available return of 5% annually, you would need to receive 1047 rupees in the present to equal the future value of rupees 1100 to be received a year from now. When a decision has to be taken, the investor has to decide whether the cash flows today are useful or the cash flows tomorrow. That's all for the session for today. If you like this video, then please like and share. Thank you.